We've got Giriraj Daga, Senior Research Analyst, and Nirmal Bang joining us from Mumbai. Giriraj, thanks for coming in. Sorry if I've kept you waiting. There's a little bit of back and forth going on how the China story is going to play out in the metal space, particularly in light of these property curbs that have been announced. Your thoughts on whether this could mean a depression in metal prices more medium term?
Of course, I would agree to that same point. So the reason being that China gross fixed asset investment is already running at a high of 65%. And recently, price increases in China property market has again led policymakers to announce new fresh property prices curbs, and that will have severe impact on the metal prices going forward also. And if I put it this way, that in the last 1 year, despite you can say enormous pumping by the developed countries, mainly US and Europe, metal prices has gone nowhere. So one portion you are saying that stimulus money, quantity using money is not going to the metal. On the second side, you said that there is demand concern in China, which is almost 40 to 45% of the entire commodity market across the globe, across the commodities. So there are concerns coming in, and it would be a medium-term concern for a quite extended period. It can be for next 8 to 12 months also, going up to that extent.
Where do you think the pressures would come in terms of ferrous, non-ferrous in particular?
I'll say, the ferrous market is directly linked to the China. Non-ferrous market is more linked to the investment demand, that is LME. So I'll say the pressure would remain in both the conditions. First, China, as I expect, ferrous market, iron ore and steel segment and iron ore segment will both remain under pressure. We directly have almost 65 to 70% of global iron ore trade is happening with China. And once we have slowdown in China, iron ore prices will come under pressure. And it will have an impact on the steel prices also because of the destocking exercise taking place in anticipation of the drop in the steel prices. Similarly, if you go by the non-ferrous metal prices, there will be low demand. First of all, China contributes almost 40 to 45% of demand also of non-ferrous commodities like LME, zinc, aluminium as well as copper. And if we say the demand is going to remain subdued, so will be the investment demand also, because you require some kind of kicker for the investment demand to be there. Either a supply shortage or either a demand, higher demand. So if none would be there, then the investment demand would be slow and all the money will not flow into the commodity market. So we'll see pressure on both the markets going forward.
What's been the domestic demand story? Has anything sort of picked up at all, on the metal side, whether it's coming in from real estate or infrastructure or even, the consumer side like auto, etc. Has there been any pickup? I know that the consumer side we haven't seen anything, but any other, positive triggers on the metal demand side?
Not actually. If you go by some seasonal demand pickup from the infra side, that would be there in the Q4. So if you see Q4 volume number would be higher than the Q3 and Q2. But if I had to compare with the last quarter of Q4, the demand is not there to the great extent. Demand is running in low single digit of 3 to 4%, 5%. So that's not the kind of demand we are looking at this point of time. So that is a negative. And the major trigger in the domestic market would be, you can say, freeing up the stalled capex project. Although the finance minister has announced the 15% allowance, investment allowance for capex. Let's see how it turned out. If that plays out, I'll say the demand will pick up in the next 2 to 3 quarters. But at this point of time, there is no signs that demand is actually picking up. On the contrary, it will remain subdued also because we are going to have planned expenditure cut.
Okay,
so it is likely to remain subdued going forward.
Keeping all these factors in mind, Giriraj, you have a positive call on NMDC and on Hindustan Zinc, I believe. Can you just talk us through those two and why you're positive there?
See, we are positive. First of all, the balance sheet completely deleveraged. Like there is no debt in the books. They are sitting on a cash of over 20,000 both the companies, or 20,000 crore of cash on both the books. Plus, if I see the valuation wise also, this company are trading at below 4x EBITDA and FY14 basis. So that is also one of the positive. Second thing is that the EBITDA margin of these two companies are over, like Hindustan Zinc it's nearly 55%. For NMDC it's nearly 75%. So even if we have 10 to 15% price correction in the global commodity prices, these companies will still make decent profitability. So we have quite a lot amount of safety, and these are the defensive picks going forward, which will outperform the entire metal pick. Based on the effects like your other income will remain steady because of the steady cash reserve, your cash accumulation will continue, your valuations are attractive, and you make decent EBITDA margin, which will ensure that your profitability remain intact even in case prices fall by 10%. So these are the 3-4 factors we are positive on these two stocks.
Got that, Giriraj. Thanks so much for coming in and explaining how you're seeing the metal picture right now. Global factors, domestic factors, and then of course individual stocks have different reasons.